you guys in the education room today. Today's room is called One Thing. One Thing. You guys remember, what was that movie with Billy Crystal? I don't even remember. But the old rancher guy. One Thing. Good morning, Bob. Good morning, Andy, Ron, Joel, Cav, Wayne. Good to have you guys here. We're going to do what we do. And we're going to do it a lot. And guys, I'm going to tell you right now. Today is tariffs go into action day. And I don't have any idea what to expect or to expect anything. So I'm just going to look for patterns. I'm gonna follow my rules. So should be interesting. But we will check news. Hey, Steve. Today's Wednesday, April 2nd. We've already gone through the non-farm employment change. And then at 10:30 a.m., we do have crude oil inventories. And if you're still stuck to your chair at 4 p.m., President Trump is slotted to speak then, and that's high impact. I check it every day looking for news. I don't care what they say, guys. I'm just looking for high impact and choosing to sit on the sidelines. Make sure you know when news is releasing. It can make the market untradeable. Then everything we talk about from the Nexgen page, guys, 100%, all the answers, specifically from the trading guide. In the trading guide, I want to share something real quick. There was a time where in the trading guide, specifically up here under trading plan, where all the rules come from, there was a section that was called your first 30 days and beyond. And I'm actually going to petition to get that put back in. Your first 30 days and beyond. How do I define my first 30 days? Maybe it's your first 30 days with the software. Maybe it is you've struggled and you're recommitting, refocusing to getting back to the highest chance of success. Everybody goes wayward a little bit, guys. There's so many siren songs. There's so many ways to use the software. But the first 30 days and beyond, encourage new users to focus on the high probability trend trade that happened after a strong top or bottom. And it did this for a couple different reasons. The first one is if you're only looking for one thing, it's easier to find what you're looking for. If you're looking for all the things, it's not as easy to find what you're looking for. The high probability trend trade is a trade that's been proven, it's been tested, it's been taught for decades with Nexgen, and it gives you the potential to win up to 70 to 80% of the time. So not only are you focused on only one thing, you're focused on the best thing, the thing that's going to create the most confidence in your life, because when you win up to 70 to 80% of the time, that confidence feels good, and it takes a lot of the pressure off of trading. So this section, first 30 days and beyond, and it encouraged you, get really good at one thing. Learn how to do one thing well. Focus on what we call the high probability trade, where everything agrees with the rules for the trade, guys. Triggers are the strongest. No termination conditions exist. There's no trouble spots between your entry and your target. This is the best of the best, and this is what we're going to talk about for the first hour. And I'm feeling a little preachy, just warning. I'm going behind the pulpit today. And Ron, you're not alone. Ron said, the more I look for, the less I see. Just saying. Guys, it is so true. And I'm going to tell you, I had to learn this lesson the hard way. Because when you're John Novak's brother, you get everything that he sees relayed to you on Skype. Every pattern, every entry, every management, every way that you could possibly make money with this software. I get this influx daily. And guys, I get excited too. And just like you guys have posted in this room, that the more simple you keep your plan, the less moving parts that are there. Everyone keeps telling me, Mark, I simplified and now I'm finding success. I got rid of that maybe trade and now I'm finding success. I didn't have to be the first one in anymore, and now I'm finding success. And guys, that's the goal. The goal is that you find that you find your comfort zone. Doing it with a high probability trend trade is the easiest way to do it. So we're gonna talk about it today, because the high probability trend trade, that's the one that teaches you to read your charts. And I put this slide in there, and I'm realizing that it's not so much because I want you to be a chart reader. I do want you to be a chart reader. But I want you to take this, whoops, I forgot, I can't highlight a PowerPoint. The first line regarding chart reading, it accounts for approximately 90% of the overall process. And what that means is that 90% of your day is looking at your charts and doing nothing. 90% of your day is sitting on your hands. 90% of your day is being bored. Find a way to combat that boredom that doesn't involve you breaking rules. 10% of your day is actually trading. So for a little perspective, if you sit in front of your computer for 6 hours today, the odds are favorable that you're going to maybe be actively trading for 36 minutes. And I think that if you've been doing this long enough, you realize that 36 is pretty optimistic. 36 is probably really high. I would say it's closer to half of that. But 90 and 10% is easier to remember. But once you can read your charts, guys, you're going to understand and use these concepts for the high probability trend trade. You're going to understand where the market is likely to continue. These are the entry points. These are where the trend that has already been established is most likely to bounce and just keep going with the trend. We're going to identify that with our entry rules. Where the market is likely to go, you're going to use key Fibonacci areas. You're going to be able to understand momentum, and you'll be able to say to yourself, man, this giant fib in my way seems like a great place to take profits. And with all this momentum, that's where the market's likely to go. And then finally, you'll understand where the market is likely to stop. And these are what we call termination conditions. And guys, if you bypass the understanding of termination conditions, if you expect to understand it in an hour with me instead of with a little bit of study, you're going to put yourself in a position where you're trading into these lines on a chart that can literally stop the forward progress of the market. And these come into play. All of these concepts come into play with the high probability trend trade, which happens to only be 3 rules. Simplicity is the path of least resistance. Simplicity, taking the fewest moving parts. There is a brilliant trader. Some of you have even taken her class. When she began trading with me, she kept frustrating herself because she wanted to take the high probability trend trade, and then she wanted to take medium probability trades, and then she wanted to take a high volume area trade, and then she needed a momentum trade. And what she did is she had 5 different sets of rules, but she couldn't figure out how to keep them separated in her mind. She couldn't take one trade by the plan because she kept throwing in items from different trades and confusing the process. So get really good at one thing first, is what that first 30 days and beyond concept is. Get great at identifying strong triggers, because when you have strong triggers, no matter what trade you're taking, you have the advantage of momentum. Get great at understanding termination conditions, because no matter what kind of trade you're taking, when there's none present, you'll have a clear path. And then initially, your rules for entry are giving you that advantage of an entry area. This is specific to the trend trades. Getting in at areas inside of favorable large triggers is specific to the trend trade. And if you use these entry rules on different trades, it doesn't line up. If you use these management rules on other trades, it doesn't always line up. Wayne's doing some awesome study right now, creating a little love child between 2 sets of rules. And I'm excited to see how that goes. And that's something that you can start to do when you're consistent. When you're making profits consistently, guys, start expanding if you feel like you need to expand. But until you're making profits consistently, simplicity is the path of least resistance. To take that simplicity even further, these 3 rules happen on only 2 charts. It's tempting to want to add more. It's tempting to want to put more indicators, to add market flow charts, to do overlays. Guys, 2 charts is all it takes to identify this highest probability trade. There's a large chart, which is a slow chart. It's going to define the direction and the momentum in the areas in the market. Lonnie will cover that when we do termination conditions, but the short answer is the mid band is the termination condition if the large triggers are a full bar away. That's the verbiage. We'll go through and look at some examples of it when we get to termination conditions. Cool? If you want to do a little study because you've heard the first part, go to the client trades, and everywhere you see gap theory, look at it. Go to the basic rules, and everywhere you see mid-band as a term, take a look at it. I know you've been listening to a lot of these rules over and over. That repetition's pretty good. But on that spreadsheet that I just dropped in the room, anywhere you see mid-band as a term or gap theory, that's how you're going to define that mid-band as a termination condition. And we will talk about it when we get to that rule. But guys, the large chart leads the way. Such a great phrase. I'm having it cross-stitched into a doily as we speak. Because the large chart really gives the overall opinion of the market. It's a very slow-moving chart. This large chart's very difficult to see change on, which means that when your first 2 rules are met, the advantage of momentum and the advantage of a clear path, when those come to be, that doesn't really change very quickly. So we use a smaller chart as an entry chart. And Bob said it yesterday. He goes, large chart leads the way. Large chart tells you to look for an entry. Small chart is how you're going to pinpoint that entry. It's a refinement process of that very broad stroke of a brush. And you're going to pinpoint where the market is most likely to continue, that concept that chart reading gives you. And by using a smaller, faster chart, you're going to be able to reduce risk. You're going to be able to maximize your profit potential. And that's where rule number 3 comes in. And these 2 charts are in play. Just a metaphor. There's not really a parking lot full of people, but ask yourself, who am I trading with? Who am I trading against? Someone asked yesterday, hey Mark, can we get some examples of counter trend trades? Well, you could, but going counter trend means you're going against the men and women that produce trends, that establish momentum, that react at areas. And they're not always bad, but for the new user, they're very aggressive. Guys, the large chart, these are the people. They wake up and they establish trends and they create momentum. And I think even most importantly, they react at those key areas that your large chart is showing you. And if you're trading with the large crowd, wins seem to come a lot easier. And the high probability trend trade is designed to do just that, to keep you in step with the people that control what's going on. The small chart, you got to think of these as just a smaller group of people with a lot of money. And they fight the large crowd. They're angry. I don't know, maybe a bad breakup somewhere. And they create these little pushes, these little retracements that are counter to everything that the large chart wants. And we love the small crowd because your third rule, your rule to define where the market is most likely to continue with the trend they establish, pinpoints exactly where the small crowd is most likely to fail, where that market is most likely to bounce and continue with the prevailing trend. So it's 2 charts. Make sure you're with the people with the power, right? We love these guys, but the large chart leads the way. All right. My first hour has been the same first hour for nearly 5 years, guys. And there's a reason. Because it works. Because what you're going to get in this first hour is literally everything that you need to be successful with the software. What you're going to get in this first hour is not everything that you can do with the software. It's important that you understand the difference. So we're going to take an hour and we're going to learn the trigger line and the Fibonacci rules for when it's okay to trade. It's okay to trade when my rules are met. Because the rules that we discuss, momentum, path, entry, it's just a pattern. It's a pattern that repeats itself every day. It's a pattern that repeats itself on every market. It's a pattern that you can go study historically to prove that it wins. So We're going to learn the rules. We're going to break them down individually. I'm going to give you everything and everywhere you need to study them. And you guys can simulate. You can stay on that simulator and practice. Wayne is doing management study right now. And Wayne, would it be safe to say you're doing management study on simulator? Because you can't hurt yourself on simulator. All you can do is get smarter and better and increase your recognition and your understanding. So guys, simulate and practice your trades every day. And then the first step in becoming a confident trader is post those trades in the room. Every time you take a trade, guys, win, lose, or draw. This is your how to annotate picture. Talk about those 3 advantages. And it doesn't have to be a dissertation, guys. Talk about the momentum that you saw. Draw me an arrow and say, hey, Mark, I had strong triggers. And talk about your path. Hey, Mark, I had a clear path, or maybe I only had the potential. Tell me where you entered. Show me where you entered. Show me where you exit. Tell me why. And guys, this is going to do 2 things, maybe 3, who knows. The first thing it's going to do is it's going to keep you focused on the advantages that create a trade. Your advantages create an edge. When you have momentum, path, and entry, you have a pattern that's been proven to win more than it loses. So if you address each, you're creating this correlation between what you see and what it means to you. Using the words. Every time I see this configuration, my brain screams strength. And every time I see one of these areas, I say, ooh, that could stop the market. And when I'm defining my entries, the words are very specific. I'm looking for areas inside of triggers, and it keeps me from searching for entries outside of the best zone. So every time you write your whys on the chart, guys, you're creating a recipe to make good trades. And then if you annotate, and the annotation tells you that you don't have the advantage, you're literally writing a recipe on how to avoid losses that you shouldn't be taking. So do me the favor, give me the best information possible. And if it's inaccurate, we'll discuss it. If you drop this in the room and you say, hey, I had a clear path, and I look at your picture and I say, whoa, that's not a clear path at all, we'll talk about the language. We'll go through, we'll make it a lesson. And I built one of those lessons today. A chart was posted and it says, hey, check it out. I had odds favorable momentum and a clear path, those first 2 advantages. But the truth on the picture was that price had reached support and the triggers hadn't broken, and that's the recipe for a termination condition. And this is not a clear path at all. This is a textbook definition of an area that has the potential to stop the market, to create untradeable bounces. And guys, you can still choose to trade into this termination condition. That's okay, that's your choice. It's not my job to tell you not to. But if you identify it correctly, if you say, whoa, this isn't a clear path, this is in fact a place that could create a big untradeable bounce, then what it does is it sets you up to manage that trade, to look for change on the small chart. And if it never happens, you may hold that trade, until you get to the next area. But knowing what you're up against, guys, it really creates advantages. And stop, Joe, stop. What it does is it gets you in the mindset. This is what I have. This is what I don't have. And since that's not present, I may need to manage. And guys, that's what becoming a chart reader does for you. So post in the room, get the feedback, accept the feedback. And for the love of God, stop beating yourself up because you don't understand something. Just take the lessons. Take the lessons and move forward. That's what the classroom does. It helps you with these lessons. We're going to simplify. That word simplify comes through 1,000 times a day in this room. Keep it simple. The plan that I give you is going to have 2 trades in it. 2 trades. That's it. You've got to learn the looks. You've just got to learn the looks. Guys, that's where the spreadsheet comes in. The spreadsheet has 4 tabs. And this is the second part of getting to where you want to be ASAP. In the spreadsheet, this has strong triggers. This is rule number 1. And all of these pictures in here. And you're going to create your own. Literally point to what it means to have strong triggers. It describes why they are strong, and it lets you know what rule it corresponds to. Go through this process and you'll always understand what it means to have a strong trigger. Do the same for weak triggers. Draw an arrow and use the words small and side. Anything can happen. Rule 1 not met. And what happens is you get to the point to where you say, okay, this is my look and this is the one that I'm going to avoid. And you're going to do that with each rule, and you're going to piece it together, and you're going to take those advantages and you're going to create a trade. The second tab gives you just a lot of study material. These are a lot of you guys posting great pictures, showing the use of advantages, giving management opportunities. And all this is just a way for new users to come through, to look, to see what other people are doing. Paul's perfect high probability trend trade short. When you look at it, he has momentum, clear path, and the perfect entry, guys. And this is your pattern. And this is just a study tool. And that's exactly what this section is going to do for you. And then you can take your pictures and build your plan. Wayne dropped his spreadsheet in the room this morning. You don't have to use Nexgen spreadsheet. You can build your own version of it, and that's totally cool. But the CME tells you, guys, from day one, oh, you want to be a day trader? Track your real-time performance, guys. Track your performance every day. And that's what the final section is. Track your performance. Drop a picture in the room and annotate it and tell me what you see. And then most importantly, go back to the feedback that you get in this room. Go back to the feedback, because what you'll find is that I don't judge you on whether you do it right or wrong. I take your chart read, and if there's a little help that needs to be given, I give it. And I look at your entries, and if there's a way to do it with less risk, we talk about it. And I look at your exits, and if there's a way to hold bigger or maybe exit sooner, we just discuss it. But if you go back to your spreadsheet, if you go back to those trades every morning, and you start to ask yourself, what worked? Well, having momentum worked, right? Not trading into areas worked. Waiting for the best entry worked. Guys, you're reinforcing the lessons and you're setting yourself up for success for the day. What didn't work? Well, this is what you need to avoid. Absolutely. Lonnie, I love this. Repetition is the key, guys. That's education. And everybody learns it at a different time. So there's math people and there's English people, right? And you know which one you are because you struggled on the other side of the spectrum. Guys, I can't math my way out of a wet paper sack. But I can write you a beautiful poem about how much I suck about math, right? So everybody sees things differently. Everything learns things differently. So Lonnie, it's that repetition. It's hearing the same thing with maybe a little twist, and eventually it ticks and it clicks. So go through this process, guys. Everybody avoids this. Nobody wants to do the work. Everybody wants the rewards. Ronnie Coleman. If you know who he is, he was Mr. Olympia bodybuilding like 8 or 9 times. And Ronnie Coleman had this famous phrase, everybody wants to be a bodybuilder. Don't nobody want to lift them damn heavy weights. And guys, I feel that way with day trading sometime. Everybody wants to be rich, but very few people want to do the work that it takes to get rich. And it's a little bit of work, guys. You've got to post in the room. You need a mentor. Michael Jordan had a mentor. He had a coach. Wayne Gretzky, Serena Williams. I'm aging myself, right? Even Nolan Ryan. They all had coaches. They all had people that sat on the sidelines and watched what they did and said, all right, I see what you're doing. Here's how you can do it better. And guys, that's my job. My job is to say, I see what you're doing. Here's how you can do it better. So learn the looks, get them in, guys. We're going to learn the rules. You're going to have everything that you need. Everything that you need to be successful with the software. The only thing I can't provide you is repetition. All right. We're going to get into what we're looking at first. You got to know what you're looking at first, guys. Triggers, small and large. Small triggers are 2 solid lines. I bet Blackbeard I bet he did. Probably someone cleverly named Yellowbeard or Redbeard. And Blackbeard thought, dang it, I can't copy. Let me dye my beard. Let me make it mine. I don't know, I made that part up. Guys, small triggers and large triggers. Small triggers are two solid lines. They're fast moving averages. If they're going up, they're green. If they're going down, they're red. Large triggers are they're dashed lines. They're usually a little bit wider, a little bit slower. If they're green, they're going up. If they're red, they're going down. Trigger lines are going to work their way into everything that you do. Trigger lines are going to define the momentum on the large chart and the small chart. Trigger lines are going to define termination conditions on the large chart. Trigger lines are going to help you define entries on the small chart. The only thing that you need to know to be successful with using trigger lines is that these are small and these are large, and then just their relationship to what you're looking at. Both charts will have areas. They have different roles depending on the chart, but the names are all the same. There's divergence highs and lows. And these are a negative number and a little cyan line from a low or a magenta line from a high. And this just lets you know that there was a loss of momentum at that pivot. Price went all the way up to that price right there. And then it headed down. And when it headed down, somewhere around here, the software said, oh, hey, there wasn't a lot of momentum in that move. Let's alert the Nexgen users. There's Fibonacci resistance. Horizontal red line runs the distance of your chart. Fibonacci support, yellow 1-to-1s. And there's even a mid-band. And guys, these have different roles on different charts. So learn their name so that when you're incorporating them into the rules, you know how to use them. And that's what we're going to do right now. We're going to take these indicators and we're going to learn how to piece three very simple advantages together to create a trade. And when I have the recipe, momentum plus a clear path plus my entry area clearly defined, that's when I have a trade as a brand new user. This is that 30 days and beyond, guys. Focusing on the absolute best. So large chart leads the way. I need strong trigger lines. The only way I can have strong trigger lines on the large chart is if I'm trading with the trend. And the trend is pretty easy to define, guys. If the background is green, the market's going up. If the background's red, it's going down. Your job isn't to jump in because you see a color change. It's to wait and look for your rules to be met to trade in the direction of the large chart. To have strong triggers in an uptrend, everything must be green. Both your small and large triggers must be green. In a downtrend, both your small and large triggers must be red. The colors must match. If they don't, you don't have rule number one met. Strong triggers is a look, and it only relies on the triggers. Has nothing to do with the bars, has nothing to do with Fibonacci. Guys, when you have small triggers separated from the large triggers, the space created between the two, guys, small triggers are up and above. Large triggers need to be getting wide, angled in the direction of the trend as well. This look, that space, whether it is up or down, think of scissors opened. Guys, that is strong triggers. And when you have strong triggers, you have the advantage of momentum. And when we talk about the advantage of momentum, guys, remember this is your large chart. Momentum is a freight train going downhill with a tailwind on a large chart. It's very difficult to stop, and it pushes the market in the direction of the trend. Momentum is what we look for to break key areas, to have that potential. Momentum covers up a lot of mistakes that new users tend to make because it's so hard to stop that a lot of times you'll get a retest through momentum. Some of you love to capitalize on that. And guys, when I have strong triggers up and everything is good, that's when I'm buying Fibonacci support on a smaller, faster chart. This big, slow chart, it looks like these sprout a little tail or a wick. When you have strong triggers up, guys, you're going to pinpoint where that tail is most likely to form. And every time you see one, it's potentially an entry for a high probability trend trade long. And when I have strong triggers down, you'll be able to pinpoint where this tail is most likely to form. And that's going to become your entry for the highest probability trend trade short. And you're going to use these tails as a study tool, ultimately. But let's go through. This is the S&P right now. And let me show you how you can study this. Two arrows right to the middle in the separation. And you can put colors match, because that's a great safeguard. Space between small and large. Strong triggers. If we have strong triggers, the odds are favorable for the market to continue in the direction of the trend. So I want you to associate that. Odds favorable momentum. Feels good. Rule 1 met. Guys, both long and short. Strong triggers down, strong triggers up. And look at that. There's those potential entries. And I don't know if they were or not. We'll go back and look at them. But that's a lot of opportunity, a lot of potential opportunity. Is everybody good? This is strong triggers. Take that picture. Go to your spreadsheet. Drop it in. Commit to the look, guys. This is your first advantage. And it's rule number 1 for a reason. We're just going to call that strong both ways. There's one more for you guys to study. But guys, strong triggers die out after a while. Momentum subsides. And when your small triggers work their way back inside of the large triggers, we call this weak triggers. And when I have weak triggers, anything can happen up or down. So let's go to that same picture. When I have weak triggers, smalls inside of the large, let's define it, same thing. Smalls inside large, weak triggers. And learn the phrase, anything can happen. Rule 1 not met. Does anyone in this room suppose that if they took 25 pictures of each of these, they would ever confuse them? No. Weak, strong. Guys, learn the difference. Let it be black and white and simple in the very beginning. But once you have strong triggers, once that momentum is there, there's things that can stop that freight train, guys, and we call them termination conditions. Termination conditions have to be false. You can't be trading into an area likely to stop the market. Termination conditions, when none are present, will give you room to your profit targets. That's a great problem to have, right? I've got open fields to get to my goals. We're just going to call it a clear path. Termination conditions, blue Fibonacci support, red Fibonacci resistance, yellow 1-to-1s, divergence high and low lines. These are all horizontal lines on a large chart that could stop the market. 3 divergences in the same area, 3 losses of momentum in the same area can stop a market. And then the large sharp midband can behave as a termination condition if the large triggers are a full bar away. So there's a little recipe for all of these, guys. These lines on your large chart, these are where the large crowd are most likely to make decisions. These are where the buyers buy and the sellers sell, and fights and reversals are most likely to happen. So the recipe for identifying a termination condition begins with allowing price to reach the area. Guys, let the bars reach the area. So if the trend is up, the market is up, it's moving up, and those dynamic Renko bars hit Fibonacci resistance, hit a divergence high line, hit yellow 1-to-1s, the only thing that you have to do is say, where are my triggers? And guys, if your triggers remain below resistance, you've reached a termination condition. And there's 4 things that can happen. You don't even have to know the 4 things. You just have to know that you'll never know which one it's going to be. Guys, this area could break. The market could just continue up. This area could set off a fight between buyers and sellers that looks like a seismograph dancing right at the area, making it difficult to find a trade. This could just create an untradeable bounce, 2 or 3 bars down, and then maybe continuation back up. But a bounce big enough to take you out of a long position if you traded directly into the area. Or it could reverse the market completely. And I saved that one for laughs, because if price reaches Fibonacci resistance, if all of the triggers remain below, and those large triggers roll from green to red, guys, we call this a strong top. A no triggers through termination that reverses the market is what we call a strong top. And a strong top is the precursor for the highest probability trend trade you could ever take. A strong top is rule number 1 for the second trade on the plan I'm going to give you. So learn the language. Price reaches, no triggers break. It's a termination. It's consistent. If it reverses the market, it's a strong top. And then the sellers are in control. They're pushing down. The momentum is great. And some of you are going to say, oh no, there's a blue line way off in the distance. That's a termination condition. But guys, it's not. That's a target until price reaches the area. That's the first piece of the equation. Price bars reach Fibonacci support. And guys, once the price bars reach, I'm done with price. I don't care what price does anymore. My trigger lines are going to let me know the story. If my trigger lines remain above Fibonacci support is a termination condition. It could break, it could bounce, it could fight, it could roll and create a strong bottom. I'll never know what the reaction is going to be. So my highest chance of success comes from saying rule number 2 is not met. No trades into the area. Everybody good with that? It's almost too easy. If price reaches yellow 1-to-1s and the triggers remain below, no trades into the area. It could create any one of those reactions. The same happened here at support. There it is at resistance. There it is at support. Divergence low and support. Divergence low. Divergence low. Big untradeable bounce. Support. Kind of cool, right? Guys, with Nexgen, you understand where highs and lows can be. You understand where tops and bottoms can occur. And you just have to commit to doing nothing until it either breaks or rolls. This is what it looks like if it doesn't roll. This is price breaking areas. This is triggers breaking areas. This is going from a termination condition to a clear path to rule number 2 met. Number 1, there's that recipe again. Price reaches resistance. Where are my triggers? My triggers remain below resistance. This is a termination condition. Wait to see what the reaction is. Guys, this is your 90%. This is the look that demands patience. This is the look that most of us falter at in the beginning because it means that we do nothing. And your brain's going to tell you, Trina, you can't make money if you're doing nothing. You also can't lose money if this reverses the market and you didn't trade into it. An area is considered broken. Your path is considered clear. We're skipping to number 3 here. When the smalls and large, small triggers and large triggers, has nothing to do with price, has everything to do with triggers. When your small triggers and large triggers, both lines of each, get above resistance, resistance is considered broken. And your path is clear until you reach the next area of resistance. So you're going to see termination, pump the brakes, do nothing, don't trade. And then once you get small and large above resistance, resistance behaves as support. It changes. Your path is clear. And with that level of momentum, you're going to go look for an entry on your small chart, and you're going to continue to look for an entry until you reach the next area. And then we go right back to number 1. Once you know the difference between a termination and a clear path, and guys, I promise you, if you take like 4 or 5 days of study, go take 50 pictures, commit to it. This isn't a long lesson. It opens the door for the second trade. The second trade is what we call a 50-50 trade. This is the trade that's on the plan that I'm going to give you. And the 50-50 is a reference to where the triggers are because the triggers tell the story. Your small triggers, if they smash through the area, embrace the word smash. If they smash through the area with odds favorable momentum, but the large triggers are lagging behind a little bit, this 50-50 look lets me know that that fib has the potential to break. Pete, let me reload it real quick. Hold on. This usually works for Jen. There you go. Let me know if that helped. Guys, number 2 is the potential to break. But because it's only potential, because the large triggers aren't above yet, you have to manage these a little more assertively. You have to say out loud, my path isn't clear. I might have to be a little more aggressive in my management. My path isn't clear yet. I'm missing one of my advantages. Let me insist on momentum. Let me demand the perfect entry area. And what you'll find is that this will become the majority of your trades. But there will be times where it has the potential to break and doesn't. And let's see if we can find another one. These fibs are holding pretty strong today. Has the potential to break, but does not. Had the potential to break the 1-to-1s, and then it traded right into a fib. Potential to break, but did not. Potential to break, but did not. And look at that huge run up, guys. And it stopped cold right at Fibonacci resistance. And you knew all the way up there that that was a spot that could potentially stop it. Maybe a great place to take profits. So guys, know the difference. First, every line you hit is a termination condition. The triggers tell the story. Price reaches, where are my triggers? Learn that recipe. Then it'll have the potential to break if it's going to break, but it's only potential. It's not a clear path. You're going to have to manage a little more aggressively. You're going to use that small chart to look for change that you can't see on a large chart. And then once the path is clear, man, all bets are off. If I have momentum, path is clear, I'm going to look for an entry right up until I reach the next area. Then I go right back to number one, right back to trading into an area that could stop the market. And there's going to be times where your path isn't clear because the areas are stacked. And it's going to frustrate you. I can tell you right now, you're going to be like, oh, I can't find an entry. This is horrible. I'm never going to make money. I've been staring at the market for 6.5 minutes and I haven't made $1,000. Guys, this is 90% of your day. 90% of your day is being patient, is waiting, is doing nothing because there's nothing to do because the rules aren't met. Futures markets trade trillions a day. Billions are exchanged hourly in the futures markets. You need to find a way with momentum and path to capture $400 a day. That's it. That puts you in a 6-figure income. And then a lot of you guys are using copiers. You take that $400 a day and you mirror it on 10 accounts, and suddenly 6 figures turns into 7 figures. So it's all about the best of the best. And let's open this up one more time. A little bit of study. That's what we call an untradeable bounce. A little bit of study is going to open doors for you. Let me open up crude oil. Termination. Potential to break and didn't. Termination. 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 And now with that momentum, it has the potential to break. But guys, if you back it up a little bit, there's momentum and the triggers are below. That might have been money. There's a strong bottom, momentum, potential to break. There's an opportunity. So we're going to go back and look at these when we talk about entries, guys. But look at the distance between the two. That's a 5-hour stretch. And it's what you don't do that very often defines how successful you are in the markets. The next one was 3 divergences in the same price range can terminate the trend. That was below the horizontal lines on a large chart. It goes to 3 divergences. And guys, this happens on every time frame. It can happen on a big chart or a small chart. On a large chart, if you see 3 divergences in the time frame, very often, you get bigger moves in the other direction. But on a small chart, 3 divergences, this is just a little heads up that things might be changing on that large chart. Large chart has the best momentum ever. It's screaming down. That area has the potential to break. If your small chart says, look at this, 3 losses of momentum in the same price range, hey Mark, things might be changing. The seas may be shifting or whatever, sands may be shifting. And this is the only termination condition that we respect on a small chart, is 3 divergences. From a low or a high, it simply says, hey, don't take the next trade. Things are changing. And then the final one is mid-band as a termination condition. And here is a prime example. And this is what we call the gap theory. And the gap theory states that if price accelerates away from the large triggers, And those large triggers find themselves a full bar away. If you hit a mid-band, it is a textbook termination condition. And it even has the power, if the market reverses, to be called a strong top. Guys, this gap theory is true on fibs or the mid-band, but this is what's going to define your mid-band as a termination condition. So when price accelerates from the large triggers, price loves to return to the large triggers. And if it hits a mid-band, it's more likely to return than it isn't, which means absolutely no long trades until that correction happens. Does that help, Lonnie? And that's in the spreadsheet, but we'll put this one in the room too. And guys, it takes a little practice to recognize the gap theory. It really does. You can go back and study it and build a little trust in it if you can find your large chart. And you'll see it. Let's go find an example of it. That's a great one right there. Here, let me make this bigger. Price accelerates away from those large triggers. Mid-band's one of the areas that's been hit, but see how it had room for a full reversal bar? If the fib wasn't there, you would say to yourself, man, no long trades yet. Let's let it close the gap and see what happens. Big run up. And there it is again, Lonnie. Price accelerates away from the large triggers, hits Fibonacci areas. Large triggers don't follow. Sure enough, snaps back right to them. Does it here as well. Snaps right back to those large triggers. And this is a great little prelude. There it is again. To finding an entry. Because when we talk about finding an entry, the rules actually say that you're going to use a limit order to buy or sell a pullback in an area, and that area needs to be inside of triggers because triggers are where price tends to return. So rule number 3 is small chart. Rule number 3 is used to pinpoint your entry or to give you that advantage of getting into the market where the market is most likely to continue. Price may return to the large triggers on both charts, on the large chart or the small chart. So your small chart has the large triggers from each. You've got your 5-1 large triggers. That's your entry chart. You'll use these in comparison to the small triggers and say, wow, look at that odds favorable momentum. What a great look. But you've got the 13-2 large triggers hanging out as well. And guys, price may return just to the 5-1 triggers, or price may go to the 13-2 large triggers. You don't know which one it's going to be, but you can use those large triggers. Put a box around them. And what you're doing is you're defining where the retracement is most likely to go because price returns to large triggers. You can make that box a lot smaller if you insist as a brand new user on favorable large triggers, because favorable large triggers means that your large triggers from both charts, your large and synthetic triggers, are overlapping. Two snakes riding piggyback. And this gives me the smallest range where that retracement is most likely to go. And then when you put a fib, a mid-band, or a yellow 1-to-1 inside of there, you're giving the market something to bounce off of. Areas inside of triggers are like brick walls and you're throwing tennis balls. So the language is that we're going to use a limit order. We're going to wait for the market to come to us. And we're going to wait for it at an area, at a fib, at a mid-band, at a yellow 1-to-1, because areas on the small chart inside of triggers can stop the market and create a bounce the same way areas on the large chart can. So that's where the precision comes in. Sometimes your triggers are going to look like this. Sometimes they're going to be favorable. This is the one with the highest accuracy. So let's define an entry. Once the rules are met on the large chart, you know what? I'm just going to use a different one today. Pow. This is from the spreadsheet. Once the rules are met on the large chart, when you have momentum, when you have a clear path, when there's room to your targets, guys, the market is trading all the way down here. Your job is to wait for a reversal bar. This is the first step in defining your entry. A reversal bar begins the pullback. A reversal bar is the beginning of the fight from the small crowd. The reversal bar is not your entry. Once the reversal bar prints, what you need to do is you need to define where is the retracement most likely to occur. From the bottom of the triggers to the top of the triggers. This big green box shows me, man, that retracement could really go all the way up to here. I need to keep that in mind. I need to understand that. But triggers aren't bouncy. Triggers are like clouds. It's like jumping into jello, guys. I need areas. I need areas inside of those triggers. That's what the rules say. So step 3 is to create a window of opportunity. I love that phrase, window of opportunity. And your window of opportunity goes from the lowest area inside of triggers to the highest area inside of triggers. And this box, this much smaller box, this defines where the market is most likely to bounce and continue with the trend. And this defines where the small crowd is most likely to fail and the trend continue. So what you've done is you've created this window of opportunity. And guys, this is how you define your entry. And you're going to learn to trust it with a little bit of study, so much so that you will activate a limit order 1 to 2 ticks below the lowest point of resistance inside of those triggers. Because remember, your large chart is screaming to the downside with absolutely nothing in the way. Joel, you can do whatever you want. But if you're using it to trade the other way, aren't you fighting trend? Aren't you fighting odds favorable momentum? Aren't you just hoping that the gap theory happens? Something to think about, my friend. But you can do whatever you want, guys. I refuse to give trading advice. I'm not allowed to give trading advice. And Joel, if that was your desire, I would encourage you to find patterns on the small chart that suggest things are changing. But I don't have a trade for it. Did that make sense? Was that clear enough without being cryptic to say you'll be fighting everything? Let the small chart tell you change is coming? Wayne's got some pretty good examples of how he does it. Watch him when he posts pictures. You may see some. Guys, you're going to activate your limit order. And you're done. You've done all you can do. But if the small crowd pushes back to your limit order, if that retracement goes to your limit order, you're in a short position and you have odds favorable momentum. And you have a clear path. And you've entered where the market is most likely to continue. Thanks, Wayne. I know I see them from you every now and then. And you do them well. Ron does them well too. And then some people just absolutely get run over. You got to learn the patterns. Guys, this is your entry. This is the best of the best. This is the biggest chance for success as a brand new user. This is the entry for the highest probability trend trade. So when the rules are met, wait for the reversal bar. When the reversal bar prints, define where the retracement is most likely to occur. Define where it's most likely to bounce, and commit to putting your limit order 2 ticks above it. The recipe stays the same, guys, every time. If they get there, you have a pattern. You've entered a trade that typically wins 70 to 80% of the time. Guys, this is your high probability trend trade entry. One more time. Reversal bar begins the pullback. It's not your entry. Define where the retracement is most likely to go by using the large trigger lines, synthetic trigger lines. Not your entry. Create your window from the highest point to the lowest point inside of the triggers. This is where the market is most likely to bounce, but because the large chart has those advantages, your entry goes a tick or two above the highest point of support inside of triggers. And the cool thing is you know where the market should retrace. You know where it's going to bounce if this is going to be one of those winners. So any lines below the triggers, any lines on the wrong side of the triggers, guys, this isn't a part of the window. This is actually where the market shouldn't go, where rule number 3 is no longer in play. Reversal bar begins the pullback. Define where the pullback is most likely to go. Top of the triggers to the bottom of the triggers, not your entry. Define where it's most likely to bounce. Area inside of triggers. Guys, write it on every entry you take. Inside, all caps. And by defining where the market is most likely to retrace, where it's most likely to bounce, you understand that anything on the wrong side of the triggers, above those triggers for a short trade, that's not part of the equation. Rule number 3 is no longer in play. And guys, we call that where the market should not go. That's where your initial stops are going to be placed, where the market should not go. 4 to 5 ticks beyond the trigger lines. Do I have any math majors out there? If this pattern typically wins 70 to 80% of the time, how many times every 10 trades can I expect my stop to be hit? Anybody? Stink it math. 10 times 70%. 2 to 3%, right? 2 to 3%. 2 to 3 times. You don't get to pick when. You don't get to say, oh, I really need this to be a winner. You say, this fits my rules, and this is where my rules are no longer there. I'm willing to accept that loss. It's a cost of doing business. Guys, small losses, it's just a normal part of a positive equity curve. You have to accept that as a trader. Losses aren't failures. Losses that don't fit the rules are avoidable, but there's lessons in everything, guys. So here's your pattern. Strong triggers, clear path. This is historical. Circle the tail. This is how you're going to study. If the tail lines up with an area inside of the retracement zone, guess what? That's your trade. That's your pattern. This is what you're looking for as a brand new user. You're looking to recognize, you're committing to these advantages, you're creating the recognition, and guys, you're circling tails. There's more information in historical study. Where'd that one go? Guys, this is a strong bottom. That's a termination that reversed the market, that gave you odds favorable momentum. That odds favorable momentum had the potential to break this fib. And you said, let me go look for an entry. And my small chart had the same strong triggers. The reversal bar printed. I defined the areas where the market was most likely to bounce in the retracement zone. And guys, if you took that trade, it was easy money all the way up to the fib. Do you guys see it? This is your pattern. This is your look. Study it. Commit it to memory. Did anybody take this trade this morning? That was early. Not a lot of you were up that early. Let's go look at the next one. This one has odds favorable momentum. Looks like there was a fib update that got you there. But look at the retracement. It pulls directly to resistance inside of triggers. It doesn't go where the market shouldn't go. And all that momentum pushes the market down. Can you give me a why if you see it? Guys, your ability to go back and study this, to come back and find these opportunities. That was just live in the S&P. Strong triggers, potential to break, and it ultimately didn't. But look at this. Right to resistance inside of triggers. Some of you will take that with one divergence. And then your second divergence is what takes you out of the trade. Morgan, did you catch that one? Because it was a strong top, because you had all that momentum, because it had the potential to break, you enter, you make a little cash, things change, you get out. You wait for the next trade. Pretty awesome, isn't it? You just did too, Joel? Are you and Morgan in the same room? Probably not even in the same time zone, right? But the patterns work. You know they work. That's why you took the trade. Pretty cool. Guys, I get giddy when like 4 or 5 of you post the exact same trade in the room. I think it's amazing. Watch this. You ready for a lesson? I'm going to circle right there. And this was right up top. And let's talk about this look real quick. And I hope somebody posts this in the room. All right. What do you guys think? Whoops. We're talking about this bar right here. Did we have odds favorable momentum? What do you guys think? I think, yeah. Did we have a clear path? Yes. Did the market pull right back to an area of support right inside of those triggers? Absolutely it did. Did I have a stop 4 to 5 ticks below, which means maybe 6 or 7 ticks of risk on this trade? Heck yeah, I did. Did I take a loser? Damn right. Why? Because anything that wins 70 to 80% of the time is mathematically obligated to lose 20 to 30% of the time. But here's the real question. Trina, would you take this again if it set up? Or would you question your plan based on one result? Absolutely you would. You'd be crazy not to. So guys, even the loser doesn't mean that the pattern's wrong. It just means it's a cost of doing business. This is a normal part of a positive equity curve. 4 to 5 ticks below the trigger lines, Joel, where the market shouldn't go. That's it. There's no management. You get run over and stopped out instantly. But if you had a stop here hoping, or maybe a stop just behind the fib hoping, you took a much bigger loss than if you simply put it 4 or 5 ticks behind the trigger lines where the market should not go. By defining your entry, you begin the management process. Pretty cool, right, Joel? Turning $120 losers into $50 losers, those savings add up. So how do we get good at it? Well, learn the basics. Keep it simple. Guys, my goal for you, my hope for you, my wish, my want, my desire, my prayer is that you learn to look at the large chart first. That you say to yourself, large chart leads the way. Let me go find momentum and path. Let me get strong triggers and no termination conditions. The easiest way to get good at that isn't taking trades over and over and over. Go take some pictures, guys. Take 25 pictures each, the way we did this morning. Take 25 pictures each. Take pictures of, where's that picture? Of strong triggers. Talk about why they're strong. Take pictures of weak triggers. Talk about why they're weak. Take pictures of termination conditions. Talk about why it's a termination condition. And hell, take pictures of a clear path and talk about why it's a clear path. Annotate on your chart. Take those pictures, put them in your spreadsheet, and study them a couple minutes each morning until you can look at your chart, look at your large chart. Here we go. Smalls are still outside, but I don't have a clear path. That's how quickly your read is going to happen. Whoops. S&P. That's what we were just looking at. Smalls are inside. Second line isn't above the areas. I don't have momentum or path in crude oil. That's how quickly you'll be able to get those first two advantages, guys. And just because you have weak triggers doesn't necessarily mean that there's not a trade. It means that you know you don't have that advantage and you can insist on the other two. Not having a clear path for a lot of you isn't a reason not to trade eventually, but you'll insist on momentum and a clearly defined entry area and probably a strong top or bottom. So when you get to the point to where you look at your two charts and you say, I have this, I have this, I have this, I'm in the trade. And whichever one is missing, it forces you to insist on the other two. And if two of them are missing, why would you trade without 66% of your advantages, right? So guys, go through this drill, use that spreadsheet. It really will. It'll set you up for success and make you a chart reader quicker. The second thing, this is the high probability trend trade checklist. There's just no reason to not know these looks. These are the patterns we're learning, guys. This checklist is designed to put you into the market with the absolute positively highest chance of success as a brand new user. And it begins with a strong top or bottom. And that's not mandatory. You can take a trade without it, guys. You're just going to have to manage it a little more. Here it is defined. A strong top or bottom is a no triggers through termination that reverses the market. And that's always the recipe. And there is no strong-ish tops. There is no kind of strong. There is no sort of strong. It's either a strong top or it's a weak top. Let it be that easy. It's either a strong bottom, termination condition that reverses the market, or it's a weak bottom because the triggers got through. You either have momentum or you have weakness. Know the difference. Here's where there's a little more thought. It's either a termination condition, it has the potential to break, or it's a clear path. Do the study so that you can tell these apart quickly. Learn where the market is most likely to continue. Understand where to put your limit order so that you know where the market shouldn't go and you can put your initial stop. Guys, this is a great study tool as you go take those pictures to make sure you're taking the right pictures, to make sure that you're annotating those pictures correctly. And then finally, the trend trade checklist here. And I love saying this because I know it sounds arrogant. Nobody in the history of this checklist has ever followed it truthfully and done worse than 70%. How many of you guys started chasing everything, finding nothing, and came back to this and couldn't believe how freaking smart you are? I've done it. I've done it. Oh my gosh, I can win more than I lose. Oh my goodness, I can define the perfect entry. It turns out I am capable of waiting for my rules to be met. And when I do, trading isn't difficult. So guys, print this out. Put it on your desktop. Hold yourself accountable. And don't phone it in. Let me cover that. If you're using this checklist and the market isn't coming from a strong top or bottom, don't lie to yourself. Be truthful. If you don't have momentum, don't lie to yourself. Because if you get in the habit of lying to yourself, guys, you're going to get into the habit of making mistakes, of not managing correctly, of fudging rules, of killing your percentage. So be very, very truthful in your annotation and your usage of the checklist. And then finally, the KISS plan. The Keep It Simple Sunshine plan. Or Keep It Simple Stupid. Or Bob, you know, I can't say yours, but it cracks me up every time I do this now. Guys, this is a stepping stone in your learning journey. This is your safety blanket. This is your whoopee, guys. This is your pacifier. This is designed to optimize your chances of success because that's where confidence comes from. Through simulation, study, class feedback, continuous practice, you'll probably create your own plan should you feel the need. Not everybody feels the need. Some of you are adrenaline junkies and you need more. What you learn in this trade is going to set you up to see more. And there's two things you have to know to sit down before you sit down to trade. And I say not on sim because I think if you're on simulator, you should take everything you see and annotate that chart and drop it in the room and get feedback. Why will I enter a trade? My goal is to only enter a trade when the rules are met. That's it. It's the easiest answer ever. Because my rules are a description of a pattern. And that pattern has been proven to win more than it loses. And if you guys take the time to circle those tails, to recognize those advantages, to prove, don't trust me. Assume I'm full of beans, right? Try to prove me wrong using the checklist. Guys, you will never skip that trade. And that's why I asked, that trade that didn't win, would you take it again? If you've done the study, you would never miss that trade, even if it's set up 2 minutes after you took a loser, because you know the pattern wins more than it loses. And that removes a lot of the emotion in trading. And it makes losses way more palatable. But then you have to know why you'll exit. Guys, exits are either taken at profit targets or when the advantages that had you enter a trade have gone away. This is for brand new users. Some of you will hold through disadvantages. Some of you are working on plans to hold through disadvantages. If I know what I'm getting into, if I know what my advantages are, I can recognize when they go away. It's a great reason to exit a trade. If I get into a high probability trend trade, I know that my advantage is lost 4 to 5 ticks beyond the triggers. I'm willing to exit. If 3 divergences print, I know my advantage is gone. I'm willing to exit, guys. And man, being willing to exit is a difficult task to master because there's going to be a little devil on your shoulder saying, Man, I know the advantages are gone, but what if? But what if it goes anyway? Guys, that's just not your money. So define your entry, because great entries create manageable trades. Great entries give you the least amount of risk. Great entries give you the most room to your profits. So guys, define your entry. Get good at the entry. Have a checklist. Commit to it. And then once you're in, you've got to manage it. For the brand new user, for all of us that are emotional wrecks and adrenaline fueled and sweaty palmed when we get into a trade, having a very mechanical if-then approach tends to yield the best results. So the KISS management plan is based on 2 contracts, entering 2, and it's designed to help you understand how to trust stop placement, guys, where to put your stops, defining where the market shouldn't go, and most importantly, it's focused on getting you paid, because that's the goal. And we tend to forget that the goal of trading is to put more money into our account than we let come out of our account. And a lot of people won't take profits. It has to be more. It has to be more. It has to be more. That's the greed factor, guys. You'll create your own plan based on your ability reading the indicators. But until you can, let it be super if-then. Let it be very mechanical. And the KISS plan is based on your ability to define entry. So don't even worry about managing yet. Define entries. Get good at it. And then it gets easier. So if my entry is 2 ticks below resistance inside of triggers, that's the high probability trend trade entry rules. Then my initial stop is 4 to 5 ticks beyond the triggers. That's where the market should not go if this is going to be one of those winners. Now I could put it 25 ticks beyond those triggers and hope that it goes down, right? Or I could put it inside the triggers and hope that the market doesn't retrace where it's likely to. But guys, the reality is that 4 to 5 ticks above the triggers is perfect for the brand new user. That's where the market should not go. And it's going to get you 2 to 3 times, guys, but you will always know where your stop needs to be before you enter a trade. And then you can make the decision on whether or not you're willing to accept that risk. And if you're not willing to accept the risk, guys, you got to not take the trade. Targets are predefined, $100 and $200. So if you're not stopped out, it means that you're getting that confirmation bar, that reversal bar in the direction of your trade from the area that was most likely to create a bounce. That's what confirmation means. It confirms that you reached the entry area, it bounced, and now it's going in the direction of your trade. And this is going to allow you to redefine where the market should not go. Your new stop will be 2 ticks above that reversal bar, or if it's a long trade, 2 ticks below that reversal bar. And now you have $30 of risk on this trade per contract where you had $150 at your entry. And there's still nothing for you to do. You're still not in control. They're either going to stop you out. Again, it's normal, but a $30 stop really isn't that bad. Or it's going to go to your first target. And if you've actually followed the rules more often than not, guys, it's going to hit that first target. And when price reaches your first target, one contract is automatically removed and those funds go into your account. And that is the success that breeds confidence and trust. And with one contract remaining, you're going to move your stop to break even as a brand new user. And break even probably isn't the best stop. But for the brand new user, it develops trust. This second contract is a trust builder. You are going to trust in the momentum on the large chart. You're going to trust in the clear path on the large chart. And you have absolutely nothing to lose with funds in the bank. And it's either going to stop you out break even, or it's going to go to your second target. And if it goes to your second target, that is a $300 trade in 4 minutes of your life. 4 minutes of your trading day. $300 trade. But Mark, $300 isn't enough. Guys, that's 75 grand a year. 75 grand a year. Throw in one break even. You're in 6 figures. 4 minutes of your life, guys. Look for profits consistent, daily, every day. Hit your goal, shut it down, do it, enjoy the year. You've forgotten how to set up a split profit? No worries. So let's talk about it. Let's set up the KISS ATM. Guys, your ATM strategies are right here in Chart Trader. So, Pete, if we were going to build a brand new one, I'm going to go to Custom from the drop-down menu, and it's going to give me options. So this particular one has order quantity 2. But I've only got one target. So Pete, the first thing that you have to do is you have to add a target and make it 1 contract each, or whatever yours is. If it's order quantity 10, well then your targets have to be 5 and 5 if you want them even, 8 and 2, whatever you want to do. Stop loss. Guys, in the crude oil and the S&P, 12 ticks gives you reaction time to put your stop where the market shouldn't go. Profits can be whatever you want. It can be 10 ticks. It can be 1,000 ticks. Well, maybe not 1,000. 20 ticks. We'll do 100 and 200, right? And then you're just going to save it as a template, and you're going to call it Pete's Moneymaker. And click OK. And now every time I get into the market with Pete's Moneymaker, I'm in 10 contracts. My stop is 12 ticks in the distance, and I have split. 50-50. If it hits my stop, it pulls me out of the trade. If it hits my target, it pulls that first profits out of the trade, and I'm still in 5. And then if it hits my stop, I'm out of the trade. That help, Pete? And then guys, I will always give you a fish, but I love to teach you to fish as well. So when you go to software user guide here, these are called instructions. For you guys that put together a grill last spring and have extra parts, those are instructions. So pull it up, and here, let's do this. Let's make a picture for you guys that show the parts. Pick your quantity. As many targets as you want that are different. Hit the add button to put another in there. Stops targets for each grouping. Then save as a template, name it, use it, live it. So to put the stop on all, so what happens, Pete? Let me give you the picture. If I have 10 contracts, right? Let me blow this up so you can see it better. Every time I enter the market, it's going to give me quantity 10. I'm going to be in at the same place probably, but my targets are separate. I wanted to divide it, but it doesn't make sense to have a different stop loss, right? Because my stop's going to go where the market shouldn't. So it's going to give me one line with 10 contracts for my stop. Let me show you. My stop is the same, 10 contracts, but my targets are divided. I'm in 10. My stop, where I don't want the market to go, and then I can even move this. I'm going to hold 5 for a runner, and I'm going to try to take 5 of them off quick. So you go through like that. But this tells you how many contracts, 10 contracts. All of the stops should be in the same spot, I think. And then you could divide these up any way you wanted to. You could go through, you could edit it. Oops. Let me close out of that. But you could edit it, and you could literally have 10 different targets. 6, 7, 8, 9, 10, 12 all the way down. Save it as a template. We'll keep it yours. And now, if I get in the market, we'll buy it. I've got 10 contracts that are stop, and I've got targets everywhere. It's working properly? Awesome. Good lesson. Great question, man. Great question. So guys, remember, you don't have to make it all to be successful. It doesn't all have to happen in one shot. Be consistent. And now I'm going to give you everything you need. I promised you that I would. So there's a zip file. Everything you need. Guys, it's got the KISS plan. It's got the chart reading. It's got the checklist. It's got the PowerPoint that I used to teach. It's got everything that you need to be successful. The only thing that's not inside of that zip file is the work that you have to do. I can't make you post in the room and get feedback, but I promise you if you do, that's the path. I can't force you to use a spreadsheet and go back and study it, but if you do, that's the path. But my promise to you is every day, 15 hours live, I'll give you feedback on anything that you see and anything that you do. So as we head towards the second hour, here's my reminder as we get into the chart reading section of class, guys. The key to everything is having a foundation, is giving yourself a solid platform to work from. And then every day, every week, compound, get a little bit better. Keep it very, very simple and let it grow organically instead of trying to force yourself into taking all the trades. So for you brand new users, I blanket you with very conservative rules, the recognition of advantages, and a solid plan that optimizes the chances of success as you learn to read your indicators. So for you brand new users, all termination conditions are bad and no momentum is bad and areas beyond the triggers for entry, it's bad. Blanket rules, because it increases the likelihood of success, and success breeds confidence. And they're not always bad, and you're going to see people in this room trading in determination conditions. And you're going to see people in this room trading without momentum, and you're going to see people getting in on the wrong side of triggers, and it's because they have the experience, the repetition, they've done the study to know when to take chances. Learn it like a scholar, break it like an artist, right? So just like anything, guys, the more time you spend with this, the more you're going to see, and it opens doors should you feel like you need doors open. Some of you are great at being patient, but you've got to learn the process that yields the results, and that's a Mark Douglas thing. Mark Douglas was probably at the forefront of trading psychology in the 90s. And when you trust the process, when you focus on flawless execution, guys, the results seem to follow. And that's where the KISS plan comes in. If you can keep it that basic, if you can follow simple rules, if you're okay not looking for every trade, and guys, I have been repeating that phrase for 4 years straight, you can find an extraordinary level of success. And I've watched it repeatedly over the years. And the further you guys deviate from the simple, the more you try to find, typically the less you find. So it takes you longer to learn how to be comfortable because you keep throwing variables into the equation. Keep it as simple as you can, guys. Question everything. There are no stupid questions. Losses are not failures, they're opportunities. All the cliche things, you have to treat yourself like a brand new student. Guys, you're brand new. Give yourself a little bit of grace. You would never scold a 5-year-old for not being able to spell, right? You shouldn't beat yourself up for not being a successful day trader. Do the work. You'll get to where you want to be. Amen, Ron. The only dumb question is the one you don't ask. So when we get into the second half of Classroom, we're going to focus on your charts, your reads. We're going to talk about every one of them. And I'm going to break them down. Where's my picture? I'm going to break down every chart read. And I will discuss whether the rule is met or not, momentum, clear path, and entry. So if you're brand new, You're going to see people taking trades that maybe don't have momentum. And I'm going to say, hey, you don't have momentum. Even if I know it's a part of your plan, I'm going to identify that you don't have momentum. I'm going to talk about the path. And if you tell me it's clear and it's not, I'm going to tell you why it isn't. And even if that's a part of your plan, you got to be okay with that because new users are learning. Same with entry areas. So your job is to just tell me why, to point out your advantages. Because if you say, I have strong triggers, but you don't, we're going to go back to the lesson on strong triggers. And if you say, I had a clear path, but you didn't, we're going to go back to the verbiage for a clear path. That's all. We're just going to make you a little better today so that you're more successful tomorrow. If there's a way to enter with less risk, if there's a way to exit with higher profits, or maybe an exit should have been taken because of the challenges in the way, guys, we'll discuss it. But I don't tell you how to trade. I don't give trading advice. I help you learn to read your indicators so that you can make good decisions. And I am not the trade police. I absolutely refuse to be the trade police. I don't believe that you guys can do right trades and wrong trades. You're just going to do your trades. In the same way, where is it? There it is. The same way you guys like apple pie. I think it's gross. It doesn't mean that it's wrong. It just means I don't like it. So some of you love momentum trades. Some of you won't touch them. Some of you love the gap trades. Some of you won't touch them. It's okay. Learn something from other people, but stick to your plan. Stay in your lane. Termination condition, guys. Textbook, 100%. Directly into an area that could stop the market. No momentum. 2/3 of your advantages are gone. Don't even have an area inside of triggers. Not one advantage from the high probability trend trade. Choose wisely. I'll be back in 5 minutes, guys. Talk amongst yourselves, post them if you got them, and then we'll see if we can't learn something in the second half of class. Back in a few. All right, y'all. Here we go. Second hour. Termination condition seems to be working, doesn't it? Pretty awesome. From fib to fib. I love it. So guys, we're going to go through and we're going to look at all the pictures posted. Joel's asking, Mark, is this a good example of the gap theory? It's not. It's not, Joel. And that's okay. So the gap theory would have these large triggers way down here when the midband is reached. What this is odds favorable momentum into a midband. So what I want you to do is I want you to learn this phrase. If price reaches a midband area, and that can be fib or one-to-ones, are my large triggers below or above the reversal bar marker? If yes, then it's the gap. So here, we just don't have it. Does that make sense? Let's go find an example of it. What you have here is strong triggers and a pullback to the areas on the wrong side of triggers. But Fibonacci support is likely to hold. And then when it starts back up, you find a way to get in. But this isn't trading the gap because you're trading with the trend. You're trading with momentum. You're trading from the areas. It's just a little different on the entry. Does that make sense, Joel? If you were trading the gap theory, what you would be doing is, let's find a good example. All right, so if you were trading the gap theory, what would be happening is price would have reached these areas right here. And do you see how these are so far away? And Joel, this is why I warn people on the gap theory. Because if you take a trade trying to trade the gap, what you're doing is you're fighting. You're fighting the trend. You're fighting the momentum. And this is what it looks like right here. Right? So what the gap theory is doing, Joel, is it's saying, whoa, don't take that long trade. Price is likely to close the gap. And if you arbitrarily jump in saying, oh, I hit an area and my triggers are all the way down here, let me go short. Do you see how you just get absolutely run over? And that's why I was saying maybe a little small chart confirmation, Joel. Maybe a close on the other side of the triggers. Maybe let the large triggers roll. Something on the small chart that says, all right, let's not just jump in and hope that that momentum and direction changes. Let's force it to change a little bit over here, because this was my loser. Because when I learned the gap theory, Joel, I kept saying, I'm going to trade the gap theory. And I would get absolutely slaughtered over and over and over because I wouldn't let my small chart change. Good question. And this is a good example. See how we hit the midband, but the large triggers are not a full bar away. They're not above the reversal bar marker. So the gap theory isn't an issue here. Good stuff. All right, I'm going to scroll up to the top of the room. Those are the kind of questions that make this classroom better, guys. Those are the kind of questions that they set off conversations, that they get everybody in a better place. All right, Wayne, 2, 3, 4, 5. I love it. Wayne says just losers. 1, 2, 3, 1, 2, 3, 4, 5. Right on. Wayne's doing some study on some management and stuff. And he says just losers. So let's see what happens. Strong bottom. No triggers through termination. Reverses the market. Creates odds favorable momentum. And do you see how the large triggers are not a full bar away? So the mid band is not a termination condition. We're actually experiencing a clear path. So rules 1 and 2 are met. And then on your smaller, faster chart, there's your pullback to the area inside of favorable large triggers. You waited for confirmation bar. It slipped you a little bit, catching it on the way up. Best entry is probably the mid band. It gives you time to get back to the first slowdown. You get 2 divergences, and you exit on the divergence. And then, Wayne, as you're working on management, can I make a suggestion? Is this yesterday? The exit is good, but as you work on management, take a picture with about 15 bars or so after the exit. Because this is going to pay huge dividends for you. Because did the market bounce from here and continue up? Because this is an area inside of triggers with odds favorable and a clear path. It did go down? Okay. Such is gold, right? It went a long way down. Right on. But I think what you'll do is you'll start to gather these pictures, these patterns, after the fact. And I guess this one failed, right? And they do sometimes. Great entries gave you an opportunity to manage. But you'll know from a sample if this is an exit condition or if it tells you to wait for the lower one, and then more often than not it bounces. So I just, as you work on management, I always try to have 15 to 20 bars after, because I want to look at the reaction, because I want to build that sample. I want to have an idea not only of what takes me out, but also what happened afterwards. I love working on management plans. I think they're fun. Chili dog fail. So large chart rules are met. Great momentum. Everything is down. And this is where, Wayne, I know that you're working on your management plan, but if I'm taking a momentum trade, close on the wrong side is a loss of momentum. Divergence is a loss of momentum. If all that I'm hoping for is for momentum to carry it, this yellow 1-to-1 presents a place that's going to create a bounce. I think you didn't have time to move it. 0649. Yeah, but you had a whole minute in between impact and exit. So maybe a little hope thrown in there, hoping it would continue down because of the large chart. And this is what I was talking about. If you know why you're in, I'm in because of momentum and clear path, you can say to yourself, well, shit, my path isn't clear anymore for momentum at these 1-to-1s. Let me get paid. And then I'll wait for the next trade, because you're an outstanding chart reader with an amazing plan. You'll find the next trade. So a lot going on here. Entered a 50-50. Thinking clear path, hit sell and said, lost 60. That happens for sure, right? You moved it to 2 ticks before the divergence. Two ticks before the divergence. I'm not sure. Like back down here? Yeah, but it already failed. And that's what I'm saying. It already failed. You're hoping that it goes and retests, right? But the small triggers have already rolled. You don't have any momentum in your momentum trade. So your momentum trade is no more. Now you're trading weakening triggers with multiple divergences, small chart showing change, this look isn't this look. That's the point that I'm trying to make, is that if it's momentum that gets you in, it's okay to let momentum or the loss of momentum take you out. This is fun for me. I hope you know this. Guys, when you're working on a plan, post them in here. Because Wayne's brilliant, but I might see something he doesn't. And we've all done this one. Hit sell instead of buy. You hit buy. You saw that it was a 50-50. Let me see where you got it. There's your little mistake. Saw the white bar at the top. Made 220. Failed chili dog. Trying a logical stop placement to see how it works over the week. And this would be the one again. You're not a chili dog. And you say failed chili dog, but it's not a chili dog. The back of the bar never even came close to clearing the fib. So what you're doing is you're trying to take that momentum trade right off of that fib, and it's not even close to a chili dog. Broken rule on the chili dog. We'll cover, does that make sense? Because on a chili dog, and guys, chili dog isn't a next gen trade, but I understand the rules. Yeah, but back of the bar has to clear. Okay. But that fib was there for 30 minutes. That fib was there for 30 minutes. That fib was there. So maybe a little tunnel vision. But that fib didn't surprise you. It can't get 4 bars deep. That's a good 20 minutes worth of fib. I'm not sure. You're staring at the tree, not the corner. You're staring at the entry, not the exit. It's okay though. And then I'm not sure, you did turn it around and go the other way. And then here is the chili dog again. If momentum is everything, right? That loss of momentum creates much smaller losses. Okay, cool. Thank you for that. Everything says down. You take the trend trade out at trouble, and then you take the chili dog, the momentum and path, and then when the momentum is gone, you hold a little longer. That was a good look. Just didn't work. Chili dog, 220, back of the bar clears, you have room, easy money, out at trouble. Actually, if you would have got out at trouble, you would have got an even better exit. This is the, man, it could break, let me put it where I would have gotten out anyway stop. Is that right, Wayne? I do that. Let me put it where I would have gotten out anyway because it broke through. The challenge with this is your second entry doesn't have momentum. And you're trading right into all those things that made a bounce. So again, management opportunity, 2 divergences, no momentum, things shifting, just long holds. That's long holds. That's the momentum style trade, right? But doesn't it take momentum to create a momentum trade? Gosh, I hear my brother's voice every time I say that. How can you take a momentum trade if you don't have momentum on your charts? Yeah, getting greedy. That's okay though. It's funny how in the moment it seemed perfect, didn't it? Guys, you're going to do this a lot. In the moment, it feels perfect. You can't wait to take that trade. You just know it's going down. And then you post it in the room and the adrenaline wears off and your pulse isn't racing and you're not worrying about the profits. and you go, oh, well, that's not momentum at all. And guys, it doesn't mean that you screwed up. It doesn't mean that you did something wrong. By coming back and looking at this and talking about this the way we're doing it, what Wayne's going to do now is Wayne's going to go, I recognized that I took a momentum trade but didn't have momentum. So next time I go to take this trade, the discussion we had will increase the likelihood of me double checking my momentum. And that's all it is. I'm not, damn it, Wayne, what were you thinking? I'm like, hey, Wayne, here's where the mistake was. And Wayne's like, oh, cool, man, didn't recognize that in the moment. So now the next time he goes to take a momentum trade, he's going to look at his charts and he's going to go, oh, here comes a momentum trade. No, wait, I don't have momentum. Maybe I should pause. Right? That's all it is. I love this. I love the study that you do. But again, I think you're holding momentum trades really, really long. Your advantage is so far gone by the time you exit these. And you know I have pictures for this. Let's do it. Creating expectations. So I did this one. So if I'm in a trend trade, if I have odds favorable momentum, guys, if I have a clear path, if I have the perfect entry, my expectation with all that momentum is I really want to get to the next area. That's where the market is likely to go. So I learned to ignore one divergence, two divergences. I learned to ignore little fluctuations on the smaller, faster chart because I have named the trade trend trade. And I know that because of the advantages, that's where the anticipation is. And then the only thing that takes me out is three divergences. But if I name my trade momentum trade, and I know that it's based on momentum, this look right here is my loss of momentum. This is my advantage gone. And it's difficult to accept that as an exit. But remember, it doesn't mean that you can't find another entry. And one of the easiest ways to get great at management is to believe in your heart that the next trade is coming, that the next opportunity to get paid is coming. And then you just say, F it, I'm out, but I'm back in, and now I'm going to ride this one down, and look, I'm out. And those little ticks add up. Like on gold. Let's say you hold and give back an extra $40 on your momentum trades. $40 a day, right? 252 trading days a year. That's your bass boat, right? Do it on 5 trades. That's your Corvette. Do it on 10 trades a day, right? That's your new house. So that math was probably wrong. So when you can define what kind of trade you're in, just name it. This is my Bocephus trade. And if I get a close on the wrong side, I exit that trade and I wait for the next one. And I think that may be something worth focusing on as you develop your management plan. Through naming the trade, you understand how to manage it a little more. That's my 2 cents. Great pictures, Wayne. Thank you for sharing all those. All right, Bob B. the man. 4 a.m. crude trading. You know what's awesome, Bob, is crude oil opens up at 2 a.m. in the European markets, and it typically moves pretty well. So you had a strong bottom. Doing squats, feeling great. It creates odds favorable momentum. Absolutely love it. Midband's not a concern because the large triggers aren't a full bar away. You have the potential to break. There's no divergence. It pulls right back to a midband inside of triggers, doesn't go where the market shouldn't go, and continues up all the way to the fib. And then you say, I'm so good at this that I'm going to trade directly into a termination condition with all this momentum because I've got room to get back to trouble. And if something changes, I'll exit. But nothing changed. And you get out when it starts to get on the wrong side of the small triggers. Bob, absolutely beautiful. Yeah, if I'm up at 4 a.m., it's because I have to pee. It's not because I'm looking for trades. Great trading, Bob. And the only thing you didn't mention is that you traded into a termination condition here, but you handled it perfectly. Wayne, strong bottom, odds favorable momentum. You take the first entry. So this is why I say get the aftermath, right? So you get in on your entry right off the midband, everything's good, but you have to realize that the market could pull down to the triggers, and it did this time, right? So Wayne takes his exit a couple ticks below, makes total sense, loses a little bit of money. Great trade, Wayne. And then it pulls right back to the next entry area. And you get in with confirmation again because the rules are still met. And that's the one that goes. It's perfect. And Wayne, you have your own style, right? I'm going to get in on the way up. I like it when the triggers are this split, when it's this wide. I love the confirmation bar. And it just made you take it twice. Great trade, Wayne. Hope you have a great day at work, my friend. I appreciate the pictures, dude. It's fun to talk about these things as you guys develop plans. I love giving my 2 cents. If nothing else, I'll give you something to think about. Maybe something that you didn't think about before. All right, let's see where we're at. Make sure I don't miss anything. Guys, if I ever miss one of your pictures, just tell me. Hey, Mark, I think you missed one at 8:47. I think you missed one at 9:15. I never do it on purpose. Fair enough, Ron. And you're welcome, Wayne. All right, Bob B. Chart read, waiting for a 50-50 to form. Strong bottom, and look at this. Bob, did you notice it's also 3 divergences in the same price range? Like, not only does it no triggers through, it's 3 divergences. I love that. Odds favorable, and you're just not there yet. And you're like, oh man, I see it, but the rules aren't met yet. 3 divergences, son of a gun. Let me sort it out before I commit. I love these pictures. It's not my rules met yet, but let me take a picture and identify why it's not my rules met so that I can focus on following my rules. Bob, this is a great picture. You guys should steal this and put it in your reasons not to trade list. All right, Pete. Pete's a rock star. Pete saw it too. I love that you posted this right after Bob's, Pete. Strong bottom. And look, I took this trade in sim because my large chart hadn't fully formed yet. 2 strong bottoms with divergence. Triggers rolled up, but not quite separated. And Pete says, check it out. 3 divergences, strong bottom, full roll, but I don't have the momentum that I'm going to risk my real money trading into an area. And he did it on simulator. He said, let me just see what happens. Perfect entry, aggressive management, and we watched that turn into 3 divergences. So different strokes for different folks. But even Pete goes, I'm willing to trade into a termination with the right conditions. This isn't the right condition. And he didn't risk any money on it, but he took some reps. Maybe that'll be the right condition later. Nice job, Pete. Exactly. Momentum. And guys, if you're new in here, I want you to notice how thoroughly these guys talk about what they see. Notice how much information they put on their charts so that they can come back and study these charts and know exactly why they did. Writing the recipe for success. writing a recipe that they can repeat day in and day out so that they can become better at what they're doing. Such an important part of what we do. All right, let's see who's next. Dun, 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 dun. Ron says, base hits make goals. Strong trending market. Back of price clears. He gets in and he gets out before momentum even has a chance. And for you guys that are trying to learn that chili dog trade, I want you to see how quickly he exits. In and out. Base hit. If momentum is the only thing getting me in, why would I hold that forever? I've seen a small chart. Have you guys looked at a small chart lately? Small charts don't straight line typically. They do sometimes. But small charts show every fluctuation. So be willing to take those quick hits. I love it, Ron. Great job on that one. Uh-oh. I think I missed one of Wayne's. Oh, no, he posted that one so I could get it. Awesome. Lonnie, let's see what you got. Strong bottom. Price reaches the mid-band. Large triggers are a full bar away. Perfect recognition of the gap theory. But you're not trading the gap. What you're trading is after the gap is closed, you're getting in on the way up. Does that make sense, Lonnie? You're not trading the gap down. You're not fighting trend and momentum and all that nonsense. You said, let it close the gap. And then with confirmation, go long. And your confirmation was this bar. Not the 7 bars up directly into the fib. Getting in with this bar gives you room back to the fib. Does that make sense? If you're going to take the long because of the strong bottom, let the gap close. This bar offers a lot less risk. You were slow, no worries. But look at that exit. Beautiful. And then the problem, Lonnie, is you're short. The gap's already done. You missed your gap theory. Now what you're doing is you're fighting trend, you're fighting momentum, you're fighting large triggers up, small triggers up, synthetic triggers up, and you're above a fib. And that other entrance right here, that's a recipe for financial suicide. You have fought every indicator on every chart. And I love that you pulled one off there. But does that make sense? Everything's going up and you went down. So that was, if you were going to try it over here, let it slow down, let it roll, close the gap, and then you really have to go, once the gap's closed once, you're really going with that overall trend. And there was just a lot of trouble in there. I like the one from low to high. And then that's where you just sit on your hands and wait for the better. Great read. Good lesson there on the gap. I like that you did that. But Lonnie, I want you to ask yourself, and you don't have to answer in the room. Do you need a counter trend trade that fights every indicator on every chart to be successful with this software? What's the likelihood of that fight winning more than it loses? You don't have to answer in the room. But I want you guys to ask yourself, do I need to fight the trend to be successful? There's actually a recipe for financial suicide. Fighting strong triggers, trading in determination conditions. Guys, those are the two biggest killers of accounts. No more shorts. Amen. Ed. Hey, Ed. Man, I'm losing a lot of nickels in this room. I'll send that recipe to you. Here you go. There's your recipe for chicken salad. If you're tired of the chicken shit. Who was this? This was... This was Pete. I love it. Pete says, no more shorts. Don't do it. No more longs. Don't do it. Large chart arguing with the small chart. Sitting on my hands. The most successful traders that I work with every day do nothing for most of the day. The most successful traders that I work with every day, their trades look exactly the same. Momentum and path. Find a way. Momentum and path. Find a way. Momentum and path. Find a way. Great trade, Ron. I know you're looking to go to the beach, so I thought I would throw that one in. Variety is the spice of life, guys. Trading is not life. Trading is a job. You've actually done nothing all day and been paid well for it. So Jen says, check it out. Termination, no triggers through, strong bottom, odds favorable. It has the potential to break, but it's not broken yet. And since I don't have divergence, I'm going to take a shot. And just absolutely beautiful. And Jen, you said close before fib. You closed 3 days before the fib. You jumped out of the car while you were still rolling down the avenue long before your I mean, you made money. Great job. But you didn't wait for price to clear the one-to-ones, Jen. Do you see that? You didn't wait for price to clear the one-to-ones. But why on earth would you? When you've got a strong bottom, odds favorable, strong triggers, no divergence, perfectly defined entry, and a confirmation bar. You weren't trading all these contracts? You should have been. You should have held them to the fib too. Great trade. That was copy trader? Right on. It's a beautiful trade. You definitely cut it short. This is one of my favorite things about management. At the time of exit, what changed from the time of entry? The large chart advantages are still the same. They're just getting better. It got better, didn't it? You got to the other side of the small triggers. The small triggers are up and strong. Like it, oh, Jen, I say it to myself sometimes. But use that phrase, what changed? It just got better. Just got better. It's a great trade. It's a perfect setup. Once you guys nail the entries, management works itself out. The more confidence you build, the more management works its way into play. Wanted to take this pullback, but the large chart not cooperating. Don't have momentum. I love it. Pete, you're showing awesome patience today. Morgan. Odds favorable. Nothing in the way. Jump in, jump out. Why so late on the entry? Just curious. Did you have to think it through? Just slow to hit the button? Okay. You still gave yourself room to make money. Great job, Morgan. You do see that it's late per your rules though, right? Doesn't make it wrong. I know your plan. I know the rules for your plan. Tried to hit right after the midband? Man. Okay, so hold on. So, Morgan, here's some hand strengthening exercises for you. Clearly your mouse's tension is set way too strong. I need you to bulk up a little bit. Have some breakfast, man. Sorry. All right. And we saw this one about how that's not the gap theory. That was a great lesson in there for it. And guys, I will kid with you every now and then because it's fun for me. So Boaz. Termination, great bottom, strong triggers, clear path. And I like this. You're like, oh, that's not quite where I want it to be. Let me catch it on the way up. And beautiful, beautiful. And then Boaz, you let it talk you out of your money. Is this a stop movement plan that you have? Or was this an oh no, I don't want to give anything back move? Because you exited a couple ticks above a mid band inside of triggers with odds favorable momentum and a clear path. Definitely not where the market shouldn't go. And if you ask that same question, what changed? Nothing. Everything is still going up. Everything is still screaming up. These are hard because that down bar scares the hell out of you. But it's just a fluctuation. It's a small chart fluctuation. Third divergence, perfect reason. Does that make sense? If you looked at your management plan, does it say entry plus 5, right? And it's the second one. Let it go for a little bit. It looks like you're on sim. I don't know if you are for real, but if you're working on your management strategy, you have to let it play out a couple times. That's why when I give the KISS plan strategy to people, I encourage them. Just let it play out. Take the losses, right? Let it get hit break even because there's so much great information. And you'll grow that plan. But if you're practicing that second contract, let it do its job when the large chart looks like this. Be willing to go break even on the second one. And you'll be amazed at how many times it doesn't get hit. Good stuff, Boaz. You're such a great trader. It's always an honor when I get to help you a little bit. All right, there's that momentum trade. Odds favorable, potential to break. Guys, this is the Nexgen momentum trade. Snaps through a little bit, pulls right back to the fib, and it happens to be inside of triggers. So this is kind of an accumulation of the two, Boaz. Momentum, potential to break, all the momentum, snap back, go. It is a momentum trade. It also fits the rules for a trend trade. It's okay. So that's the one. If you get in here, this is where naming it helps. And let me show you what I mean. I like annotating charts. It helps me think through things. So if I call this a momentum trade, 2 down bars, and I'm out. If I call it a trend trade, my stop goes where the market shouldn't. So it's a very different management plan. On a momentum trade, I'm right here with a tiny little loss. If I decide this is a trend trade, my stop goes where the market shouldn't. And risk is huge, right? That's a lot of risk. So a lot of times, what people will do that take these momentum trades, it goes like this. If my momentum trade fails, no worries, small loss. I'll see if the trend trade sets up and re-enter. Does that make sense, Boaz? Label this your momentum trade, and it either runs like it did or it didn't. Take that 4-tick hickey. Who cares, right? And then when it gets down in the range, you can decide to re-enter. Great stuff. If you want this for your plan, get out of my head, Miss Trina. That was a big run. Why? Because there was all the momentum in the world. It's okay. It just wasn't your money. Not this time. It will be eventually. Ed, let's see what you did. Only one thing I can find wrong with this, Ed. And you shouldn't have realized anything. Not at all. You can't. And I know you hate to annotate charts, so I'm going to annotate them for you. You had strong triggers. Rule number 1 is met. You had a clear path. Rule 2 is met. And then Ed, the one thing that you didn't have. Are you in here, Ed? Guys, a lesson for everybody. If you start talking about the advantages that you have or do not have, I have strong triggers. I have a clear path. Ed, 32 flavors of awesome going on the large chart. That divergence didn't print until, I mean, my gosh, you were already out of the trade. Reversal bar prints. Those triggers define where the retracement is most likely to occur. Areas inside of that box define where the market is most likely to bounce. Once you get to the wrong side, it could be a mid-band. It could be a fib. It could be a yellow 1-to-1. It could be a yellow 1-to-1. It could be a mid-band. It could be a yellow 1-to-1. It could be who knows? Once you get to the wrong side of the triggers, guys, there's no telling. So what can you do? Ed, confirmation bar, right? So with this look, I'll enter on an up bar from the area. And if I don't get it, I won't enter. And Ed, your chart reads perfect, dude. Your patience is amazing on this. And I love to celebrate victories, and that's a victory. But that one little bit of language, from rule number 3 changes the whole dynamic of whether or not you enter that trade. It's all right. We're going to focus on this one. I never look at your charts and go, great job, Ed. Let's see what you screw up in an hour. That doesn't seem right. Ron says, counter trend. White bar really shouldn't work trade. I love that he named it this. What's Ron saying? Ron's saying, check it out. I see odds favorable momentum. I have a clear path. He goes, when I get a second divergence, it's more likely to push down. And that's exactly what he does, is he grabs the push down to trouble. He says it usually goes to the reversal bar marker. Guys, this is aggressive as all get out. And Joel, remember when we were talking about maybe trading the gap theory? In with second divergence. Steal that. Go study it a little bit on the gap theory. He forces the small chart to dictate changes coming. So 2 divergences. It's the second divergence that gets him in. Pretty cool. it's fun how we are a community here. How people, we're going to learn off of each other all day long. Strong triggers. Nothing in the way. Took the confirmation because of the big window. Easy money, right? Joel, this was you? Did I read that right? So the only thing that I can say, Joel, is your triggers hadn't cleared yet. What does that mean? That means if something goes wonky over here, you can manage, right? That's it. It's a beautiful look. Look at the momentum. It's screaming. No divergence, strong triggers. I love your entry. This is not a bad time to wait for confirmation because it could go to the mid band. It could go all the way down to the fib. That's a huge amount of risk. So you mitigate it with a confirmation bar. And you're also saying with all this momentum and everything going up, I'm going to make it go up to get in. Great trade, Joel. Pete, who has been the most patient man in the day, is still. This is what's messed with your head as a trader. You're itching to take a trade because you've been sitting on your hands, but you resist because you just don't have the large chart look. Sure enough, you get a 40 tick move and it tells your subconscious you should have taken it and made all that money. So next time you take it and get slaughtered, you have to develop the discipline to stick to your rules. It wasn't your money. Wow. I got chills, Pete. It wasn't your money. There's so many opportunities in the market. So many opportunities in the market. Crude oil trades about 200 billion is exchanged daily in it. Profound, very profound. But we all have to learn that lesson, and then we have to forget that lesson and get our asses kicked a little bit, and then we have to learn it again, and then we forget it on a day, maybe we didn't have enough coffee, and then we learn it again, and you just keep going until you trust it. But this is it right here. It wasn't your money. Pete knows that the next trade's coming. He knows that the market rarely gets stuck for an entire day, and he knows he's going to capitalize. Thank you for that post, Pete. That's the stuff I think new users need to hear. I really do. I think new users need to hear that. That it's okay to not be in the market. That it's okay to not take a trade. That it's all right to not break your rules. The next one's coming. All right. This was Joel. So medium strength triggers. Joel, what does medium strength triggers mean? I've talked about strong triggers and weak triggers. I have never turned the setting to medium. They're medium high triggers. So, Joel, what you have here, just so that we can talk about it consistently in the room. What you have is a market that has gone 30 bars in the same direction. Let's take a picture. Guys, when I take pictures and annotate them, they're good pictures to put into your spreadsheet to study. When the market, hold it, large chart is 30 bars, same direction, no reversal bars. You'll see this, people call it the train track look, where the small ride the large. This is rule 1 met. Consider them strong if strong trending market rules are true. Does that make sense? They're not medium strong triggers. This is a strong trending market. Pretty cool, right? So you're adding more to it. So you have strong triggers. There's nothing in the way. And oh, you got head faked. So let's talk about rule number 3. You take the confirmation bar because of the look, and it doesn't work. They wanted to push down a little bit. That's okay. But you said, wait, all of my rules are still met. That's my money. Great job, Joel. Great recovery. You took the right trade. You took the confirmation bar, right? You took the one that fit your rules, and it didn't work. And you had 2 choices. You either cry your eyes out and get pissed off at the market, or you get back in the game because this chart didn't change. And this right here is the difference between experience and novice. This is the difference between I've seen this, I trust this chart, and I know they don't all win, let me get back in. And, oh, this sucks, market sucks, I suck, I'm no good, I can't believe it, this is no good. Let me bitch about it while I watch the right trade run to the target. Great job, Joel. Great recovery. How to empty your account in half an hour. Not the right mind for trading. That was a good long that didn't work. That was a short. I could get on board with the first short. The second short down here, or the short down here, is right into the termination. This doesn't have momentum or path. This is right into the... man. That happens. That happens sometimes. Have you guys ever noticed, is it just me? Think about your losing days. Do your losing days have more trades or less trades than your winning days? Have you ever looked at that? My losing days always have more trades. Why? Because my losing days, I typically break the rules more. And and I don't think that we think about that automatically. But if you go back and look at it, you're like, wow, I took 35 trades today. And if you go back and look at them, you discover that 5 of them fit the rules. And if you just stuck to that 5, you would have been up money. Avoidable losses. And I'm telling you guys, this is the most real journey. Everybody's on it. Everybody's on it. Everybody makes mistakes. Everybody's going to have challenges. Everybody is going to blow out. Everybody's going to get mad. Everybody's going to be elated and happy. But what we're looking for is the patterns, right? We're looking for the patterns that are bringing the success, whether it's in ourselves or in the market. Look at this. Strong triggers, nothing in the way. Ride the momentum for a base hit. Ed, take care, man. We'll see you next week. You know, you can trade on Sim for the rest of the week if you wanted to. Build up some reps. Post them in the room. It's easy to follow rules on Sim, guys, but there really is some confidence that comes from it. Ron, great trade. Odds favorable and clear path. It's just so hard to argue with that. Odds favorable and clear path. Joel, strong bottom, strong triggers, potential to break. You wait for the confirmation. I don't know that re-entering at the pivot was your highest chance of success, though. Because what were you doing when you re-entered, Joel? That's the bar that you re-entered on. 2 ticks below 1-to-1s that had been hit with all the triggers below. Do you see how this one gives you room to trouble? This one is directly into trouble. And you got away with one, right? You got away with one. These are the ones termination conditions create bounces, guys, all the time. All the time, terminations create bounces. So just be aware. Love this one. Joel, do you hit buy now? Is that how you're entering these with confirmation? Can I give you a trick? Here, let me give you a fish and let me teach you to fish. 1 second. All right. Buy and sell stop orders. So there's what I'm about to talk about. So sometimes trading, you feel compelled to wait for a confirmation bar. Timing the reversal bar, especially in a fast-moving market, can be a daunting task. There's that English Lit degree coming out. Using buy or sell stop orders allow you to have an order waiting right where the reversal bar marker on your small chart. So what you're going to do, this didn't even have pictures. Yeah, it does. So if it's going to take a reversal bar up to get me into a trade, what I'm going to do, and let's go to the live market. Let's say that a reversal bar will get me into this trade. I can right click and I can put sell stop. Whoops. And what that means, is that if price creates a reversal bar, that's my confirmation, right, Joel? Not that I'm going short with everything saying up, but it forces the market to give me that confirmation and it pulls me out of the reaction time. Same thing. Right click, sell stop limit 2. I don't know why it's making me confirm. If I get a reversal bar, that's what you use, and it's still slipping you 5 bars. I usually get like a 1 tick slip. Maybe. That's what you're using though, huh? Okay. Well then, dang it, there's nothing I can do for you, Joel. You've already got it. Man, look at that. Zoom, baby. This would be that strong trending market. See the train tracks? That's your strong trending market look. Rule number 1 is met. Rule number 2 is not yet. Not yet. Guys, we've got 30 minutes. Let me take like a minute and a half, and then when I come back, we'll start answering any questions that you have. Post them if you got them. Guys, if you're in my class and you never say anything but you need help, do me a favor. Tell me what you need help with. I love to talk about it. Absolutely love the sound of my own voice. Not really. If we get a reversal bar here, guys, strong trend is over. And then it takes another 30 bars to reestablish. But notice how there was never a clear path? Boom, strong trend is over. It would take another 30 bars in either direction to establish a new strong trend. I'll be back in about 2 minutes, guys. All right. So let's get into the last part of the day here. Joel, let's see what we have. Dun, 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 dun. Strong top, Odds favorable. I love this. Divergence printed. Took it anyway because I have ego sometimes. Yeah, you do. And lost. Man, it's a good look. Joel, it's a great look. The divergence typically kills it. And then the second divergence just put the nail in the coffin. So Joel, here's a hypothetical. What if you had a strong top? What if you had a 50-50? What if you had a divergence? But instead of weak triggers, you still had odds favorable momentum on the small chart. Might create a different scenario, don't you think? But here, we're relying on momentum to break it, and you're losing momentum in the form of divergence and in trigger strength. So it's kind of a double whammy, but a lot of people don't look at the trigger strength on the 50-50. A lot of people default right to the divergence and think that's the only reason. But when you go to the KISS plan and you look at the 50-50, that's number 3 on the checklist. And that's pretty ignored. Guys, momentum is momentum. And when you're relying on momentum to break areas, it's okay to insist that both charts have it. There's a good example. That one had the potential to break. And with no losses of momentum, it did in fact continue down. Good lesson there. Pete, thought I had one, but the market had other ideas. And there it is. Weak top, strong triggers, divergence. Got within 1 tick of your target. Oh, man. And this is one of those ones where you guys can use the reversal bar marker and lose a couple ticks. And then maybe you get confirmation later, you retake it. Man, that stinks to be so patient. But I'm going to point something out for you. And Pete, you are the king of strong tops and bottoms. And that was a weak top, not a strong top, right? So then we couple the weak top with the divergence. And that turned into the double whammy. If I'm going to, and guys, I'm not telling you how to trade. If I'm going to ignore this, I better have a strong top. Does that make sense? And if I don't have a strong top, well, then I better not have this. I don't want both of those stacked against me. I don't want to have 2 of my rules not met. Yeah, sometimes your gut gets bored, Pete. That's when I feed my gut, which is why it's growing. I'm bored. I want to trade. It's a good look. And you start thinking about finally rather than, oh, wait. Good stuff, though. And man. Large chart, strong trending up. Andy, how did you define your entry? You just waited for it to get to the wrong side of the triggers with divergence and thought, that's a good reason to go up. Decided not to wait for the mid-band or any areas. And it did. It went up. Strong trending market right off the mid-band. Much better entry. And then you're out of trouble. And then it's still strong trending. And now you wait for the mid-band. And that one makes sense. Andy, did you just get tired of waiting there? And how much risk were you willing to put on that trade before you let it go, right? Second one I love. You used an area. This one, man, not only did you get in at 60 and it went all the way down to 50, how did you know it was going to stop there and not go all the way back to these triggers or that mid band or that fib, right? How big of a stop do you need when you're on the wrong side of things? Something to think about. I love the second one, Andy. Bad Andy. Miss Jen, weak top, 50-50, divergence prints. You think you're going to trick the market getting in 3 bars down. And then same thing, Jen. Could have been a much smaller loss. No worries. Confirmation's great, right? But if it's already an iffy trade, and let's do this. Weak top. Here's what I get though. And these are things that people don't think about. Not only are you trying to get through 7109, you're also trying to get through 7119. Do you see that? So you're hoping that a weak top and divergence is going to blast you through all of these. And again, I'm not going to tell you don't wait for confirmation. But what I'm going to say is that if you are going to wait for confirmation, remember, this is a medium probability, poorly setting up trade. I'm going to love the shit out of that reversal bar. Pardon my French. I'm not going to give it to the other side of the triggers. I would rather take a tiny hickey and re-enter than to put ginormous risk on a trade where I can't seem to stop giving up advantages. Does that make sense? That's your hope stop. You had entry at the reversal bar marker, it just popped quick. That happens. Yeah, it started to snowball a little bit. And Jen and Pete, I'm gonna get both of your backs on this one. I can't tell you how many times I've taken the wrong trade because I was just sick of waiting for the right trade. It's that stupid human thing we all have going on. But you're not alone. And I think, again, I'm such a fan of this community. Because if everybody decided to kumbaya and be supportive real quick, there would be a lot of hands in the air from people that have done that. A lot of people saying, yeah, I gotten bored and taken the wrong trade. I sat for too long and broke my rules because I want to be active. I get it. I get it. Hopium. That cracks me up every time I hear it. Joe, let's see. I like this. That's a strong bottom. Do you guys know that? Joel, here's your gap theory lesson. Price reaches the mid band. Large triggers are a full bar away. Joel, that's your exit. Do you see it? It's weird when you're already in it, right? Great short. But when you got to that mid band and the large triggers were a full bar away, that's your don't give it back look. Does that make sense? There's your gap theory. Yeah, great target there. Awesome looking trade, dude. Just held it a little longer. And then this is a strong bottom because that's a termination. The mid band, when the large triggers are a full bar away, this is a termination. And then it reverses the market. And with everything going up, you take one entry right here, and I'm not sure what that entry was. That was this one. That was that little pullback. You get it with confirmation. And then everything says up, and it's still cranking up, right? And you say, hell, I'm going to add on and take it to the fib. I love it. 54, 56. And that one's not on here, but I like that one too. And this is great, dude. It's odds favorable, clear path. Areas on the wrong side of the triggers. Great reason for confirmation. But when the large chart rules are true, it takes 3 divergences to get you out. So you just add on to your position because everything still says up. Joel, this is awesome. Great stuff, dude. Letting the large chart lead the way. Understanding that it takes 3 divergences to kill that bad boy. Really nicely done. I like it. You guys are killing it in here. Look at that. Ugly triggers. Talk about a market rattling in between. Look what your small chart's doing. There's your fight. There's just no trade. After that much distance, buyers and sellers are trying to figure out who's going to win. And guys, there's no clear indication on which one it's going to be yet. Good stuff. Whoops, there's nothing there. Let me go to crude oil. 50-50 that got us from a bad top, and look what the market did. Heading right back up, isn't it? Pretty cool pattern there. All right, we've got 10 minutes, 15 minutes. What do we want to talk about? Guys, I think today, if you survive today, great job. I didn't know what to expect with all the tariff stuff going on. There's investors that use news, guys. And with all that indecision, who knows, right? All the more reason to follow patterns. But you can't be surprised that things are wonky when the world's a little wonky. Odds favorable, almost broken. Confirmation. No. What's this first one? That's it right there. Joel, that's trading directly into a termination condition, my friend. Do you see it? And not only is it a termination condition, it's a termination condition with a divergence coming right off the fib. That's a gutsy move. There's no room to manage if it holds. You're already at trouble. And just a little bit of patience, and then you get the real trade. And zero reason to wait for confirmation on that second trade. Good job, Joel. That first one's going to bite you in the ass more often than it doesn't. That second one is brilliant. Great job. You can make a living like that. Uh-oh. Hold on. Joel, will you repost that one? It's a dead link for some reason. Maybe you cut off one letter. Nope. Let me see if I can modify it. That was mine, or maybe that's just what I pasted from mine. Sorry. Third time's a charm. Boom! I love it. Weak top, 50-50. There we go. No divergence, strong triggers. Ha ha. Looking back, know the rules. It's crazy. You took that trade in hindsight. Yeah, hindsight is brilliant. I'm freaking genius with hindsight, Jen. But just like anybody, you get caught up in the moment and you're like, yes, this is it, finally. And then it isn't it. No, okay. Well, I won't tell you how to feel. I've been married long enough to know I shouldn't tell you how to feel. But I can tell you that I don't think any less of you for breaking a rule. I think it's a great lesson. In the same way that I posted earlier, when you post it, when we get to have the conversation, you'll think about it. You will. You'll think about it. And you'll be less likely to repeat the behavior. Look at this one. Weak top, right? Whoa. That first rule's not met. But look at his entry chart on this 50-50. Not only is it strong triggers, but it's also no divergence. And the entry is clearly defined, and you didn't get run over. You just exited late. Joel, and I won't tell you what to do, this is negative. This creates animosity with the market. You didn't get run over. Your 50-50 didn't work and you got stopped out. Does that make sense? You didn't get run over, you got stopped out. That happens sometimes. But let's talk about it. You probably entered because no divergence, right? And I think that you've really got an affection for confirmation bars that's bordering a little unnatural. But you have to say, so here we go, a little mindset here. I'll take this 50-50 trade, but it's not a clear path. And if I see change, I'll need to exit. Change would be, what is it? It's on the plan over and over. Divergence, right? That was the change that you saw, Joel. And here's the hard part about being a day trader. Is you knew that divergence was true right here, but you held your stop anyway. Which means we've got about 5 ticks of hope. Does that make sense? Because I know it's not perfect, my management plan says exit with divergence. Hope kept me in 5 ticks after divergence was true. You didn't get run over. The market told you it was changing, and you hoped that change didn't affect your trade. And that's okay. That's normal. But when you get in and you tell yourself it's not perfect, you've got to get that management hat on, guys. You've got to say out loud, this isn't perfect. I'm going to have to manage it. I like it. I don't know that I would have waited for confirmation there, to be honest with you. And again, why? Because it's not the perfect trade. But if I get in at the area inside of triggers, Joel, I've got 5 ticks of risk on that trade. Maybe 5 ticks of risk. If I get in with the confirmation bar, I've got no less than 12, which is better on a medium probability trade, 5 or 12. I say 5. Does that make sense? Confirmation bars are great, but there's a cost for it. And sometimes it's appropriate, right? So if all of your areas were on the wrong side of the triggers, Joel, absolutely, because you don't know if or where. But you've got the most clearly defined 1 tick wide zone where if that thing's going to bounce, that's where it's most likely to happen. You just drop your stop right on the other side. You're wasting your investment on a confirmation bar here. Let me see if I can find, I hope that all makes sense. I love that you're posting so much. Strong triggers, and it's a clear path. You haven't reached the fib. Your entry is at the well-defined area inside of favorable large triggers. That's your trade. That's your moneymaker, Joel. Here, you're trading directly into resistance. Bought after the third divergence on the small chart, and because of the great bottom on the chart, 3 high divergence small chart, I'm hoping the market to break resistance. Did it? Or did a Fibonacci area with absolutely no triggers through stop you? It looks like it stopped you. $41. Okay, this is this trade right here. Your exit was at 46. In at 41, perfect trade. There's your trouble. There's your reason to exit. There's got to be a point where you just say, man, 3 divergences, Fibonacci, losing steam. Let me get paid, right? I'll find another entry. Your stuff's printing wonky, but I see what you're doing. It's a beautiful trade, Joel. It's perfect. You still have odds favorable in a clear path, clearly defined, and I think that you're ignoring a bunch of red flags. Joel, take care, man. Simplify. Simplify. How'd we do today? I feel like there's a lot of good lessons in there. I feel like little things to think about. A lot of repetition. A lot of things we can all do better. A lot of things that we're doing wonderful. So tomorrow morning when you wake up, who cares what you won or lost today? It's in the past. Tomorrow morning when you wake up, what worked? Well, when you guys had strong triggers and a clear path and you entered at the area inside of triggers, more often than not it worked. We saw one that didn't, but more often than not it worked. What didn't work? Weak top and divergence on a 50-50 got a lot of you, right? Ignoring divergence in a medium probability trade got a lot of you. So you have something to focus on tomorrow. Not giving yourself room to your targets got a lot of you. Hope. I love hope. I'm a big fan of hope. Love Star Wars, New Hope. Just hope's not the recipe. So it's pretty awesome. Pretty awesome that you have such a well laid out plan in front of you. Let me learn a couple rules. Let me keep it simple. Let me focus on looks and patterns instead of results. And let me execute flawlessly, because that's what brings the results. Mark Douglas said that. I love Mark Douglas. Jen, when was the last time you watched a Mark Douglas video? When you stop expecting to win every trade, guys, you will start winning most of your trades. Last weekend, when you don't care about the result and you care about the execution of your method, guys, that's what does it for you. He's amazing. Highly recommend him. I don't make a lot of recommendations. Walking the dog and listen to him, I like that. Do you speed him up? He's the king of the awkward pause. He like pauses and stares at you. He's like a hippie at a party that plays guitar and never breaks eye contact. Guys, that's uncomfortable. Don't do that. I like that. I never thought about that. I should listen to him when I walk the dog. You'll never know what's going to happen in the market, guys. All you can do is trade patterns. That's it. What a great day. I love it when you guys make me smarter. So check it out. 50-50, no divergence and strong triggers, and you get the bounce. Divergence prints. Can we create any sort of expectation there based on patterns that we've studied? Strong bottom. Odds favorable. Clear path. See? Appropriate, Joel. Too much risk from here. That's on the wrong side. Wait for confirmation. I love it. Out at the first sign of trouble. Let the next one ride. right up to trouble. This is beautiful. This is perfect. What a great trade. What a great trade. Nice job. You guys make me so proud.